Welcome to Retirement Key Radio with Abe Abish.
I want to start with this surprising statistic from Bank of America, Abe. They say investors have put more money in stocks in these last 5 months than they have in the previous 12 years combined. That just sounds like a staggering number to me. And it raises two questions that I want to ask you, which is one, obviously, why do you think this is? And then two, doesn't this continue to reinforce the concern that we're in some kind of stock market bubble that could pop at any time now?
Yes. The answer is yes.
Okay.
Heather, I would say FOMO, the fear of missing out. Right. Just like this whole crypto run up. I mean, you just see all of these things going up and you feel like you're going to miss out if you don't get in on it. And then if you don't get in on it, how are you going to feel? You're going to feel like you missed out on something, right? So you're going to put money in at all-time market highs. Everyone and their mother and grandmother and teenager is investing right now.
That's the
Everyone is investing. $570 billion have gone into the market in the last 6 months compared to $450 billion the last decade. Let me say that again. $570 billion have gone into the market the last 6 months compared to $450 billion the last 12 years.
Wow.
Do you think that we are potentially sitting at like a bubble that can pop sometime? Absolutely.
Yes.
How could you think otherwise? And this is just ridiculous. And it's not just a stock market. It's the real estate market. It's the crypto market. It's the everything market. It's just real estate around here is crazy too, Heather. It's insane. You know, real estate properties are just flying off the market. People are getting outbid 5 to 10 times over. It's just crazy, and it's definitely cause for concern. So yes, I mean, I think it's definitely something to be concerned about. And so we have a lot of people calling into our show and from our TV show and other avenues where we get our message out and just concerned about what's going on. And so, as you know, almost all of our clients are 55 to 75 years old.
Right.
And when this bubble pops, because it will pop at some point, that's what the market does. Do we really think the market's going to go up the rest of our lives? I hope not. You know, it's already been on a 12 to 13 year bull run, and it can't continue to go up forever. We're hitting all-time highs. I really do think there will be a correction, probably a significant pullback and correction sometime this year or maybe in the next year. But right now, the market's just riding on euphoria and, you know, the economy opening back up and vaccinations. And there's a lot of good there, but man, we're just buying at all-time high prices. So we got to be cautiously optimistic, especially if you're 5 to 10 years away from retiring or less. We have a lot of people that are coming in saying, Abe and the team, I'm retiring this year. Like, I'm retiring in 60 days. Can you help me? That's not a lot of time to ride out. That's no time to ride out really any loss in general. So we just had a couple that called in from Fairfax Station and Fairfax, Virginia, and they have about 1.4 million saved. They are in their early 60s, retiring this year, as a lot of people are. And here's the deal with them. $1.4 million saved, a great amount saved, but they have half of their retirement dollars in cash and half of their retirement dollars in stocks. Isn't that kind of weird? Like, hey, in your retirement accounts, your 401ks and IRAs, you really have half of it in cash? Well, yeah. Why? Because this couple is about a 5 on our risk scale of 1 to 10, meaning they want some of their monies in stocks and equities and the growth portion of the market, but they also, Heather, didn't want to have large losses on the other part of the portfolio. Right. And so they don't like bonds. They think bonds stink, and we do for the most part as well. Why? Because right now, with interest rates being so low, I mean, you'd be kind of lucky if you got more than a 1 to 3% yield on your bond funds and assets in your portfolio. So, and then on top of that, if you're paying an advisor a fee and your assets are only earning 1 to 3, you know, the bond portion of your portfolio, then being charged a fee on top of that, that's not too good of a deal for you, is it?
No, it ends up
So this couple has half their money, in cash. And that's not great either, because even though the cash is obviously safe and protected, it hopefully won't lose any money. It's cash, right? The issue with cash is Sure, it's liquid. That's a great feature, but
Sure.
it's not doing anything.
That's right.
It's really losing money. It's not keeping up with inflation. This is the big reason why they called into the show and took advantage of our Where Do I Stand plan. Didn't want to take on more risk in the market, so they have half their portfolio in cash.
Okay.
Looking for alternatives, alternative places, alternative solutions to the bond asset class and to cash. Concerned about the state of the market. The market's obviously very overvalued. It's continuing to go up. They were concerned about when the market is going to correct and when it's going to take a step back. So we show them how to invest that cash portion of their portfolio into strategies that can protect part of their principal, can give them decent yield, avoid market losses sometimes. If you're going to have a loss, maybe minimize that loss to 5 or 10%, something really conservative,
Okay.
where they're not going to just go back further into the market.
Right.
And that's what a lot of people are doing right now, Heather. Unlike this couple, a lot of people have just said, you know what? I can't get yield anywhere else than stocks. I can't get yield and growth and interest anywhere other than the equity portion of my portfolio. So instead of going to cash and bonds, a lot of people have just taken on more risk in their portfolio. And that's the opposite thing that someone should do as they're just about to retire or just into retirement. So Heather, we show them how they could invest half of the cash they have without worrying about losses, some of that cash, and without worrying about large losses with some of the cash as well.
What's so frustrating for so many investors right now is trying to discover options and ways to create that return and that inflation protection that so many of us are worried about. I feel like inflation is the new financial word of 2021 and trying to defend ourselves against these kinds of risks. But the bottom line is having what I heard somebody refer to as dead money, which is just cash or just something sitting in bonds. That's a risk of its own. And what Abe and the team can help you do is use that Where Do I Stand plan to show you ways to have principal protected money that you can invest and see growth on within your own account. That's what they are ready to show you in a plan of your own. And if you want to learn more, you can do that anytime at retirementkeyradio.com. So besides market risk, another major area we all need to plan for is our future taxes. And you remember when you were young and everybody advised you to save to a 401k because it was, quote, tax deferred. And at the time, that sounded pretty smart. But IRA expert Ed Slott tells the Motley Fool the problem with those traditional accounts is that they're basically ticking tax time bombs.
Is the tax building up in what may be your largest single account, your IRA and 401k? It's a big bag of tax. When do you realize it? In retirement. And it's a big problem because that's the worst time to get hit with the tax bill, just when the paychecks stop, and who knows what future tax rates could be.
So we're stuck with this big bag of tax, as Ed calls it. But Abe, is there anything that we can do now?
Absolutely, Heather. It is a big bag of tax. It is a probable ticking tax time bomb. Why? Because we bought into one of the biggest myths of retirement planning. And I heard a lot of people saying this, when I first got into this industry almost 20 years ago, a lot of people would believe that when you retire, you're in a lower tax bracket. That was the myth people bought into. You're going to be in a lower tax bracket when you retire. Really? Are you really going to be in a lower tax
Doesn't
bracket?
appear to be that way.
Yeah, absolutely. For a lot of people, no way. For some people, yes. But for a lot of people, no way, especially people working in this D.C. Metro, Northern Virginia, Maryland area with government pensions and teacher pensions, Social Security, $1, $2, $3, $4 million saved on top of that. No way are you going to be in a lower tax bracket when you retire, or let's say probably not, right?
Okay.
Because a lot of our clients' incomes, Heather, are higher in retirement than when they were working with fewer deductions, And that doesn't count the current president probably changing up this tax code. And that doesn't count us being at all-time low tax brackets and rates and them probably going up without us being able to control that.
Right.
So we just had a couple come in and they've done an amazing job of saving. They live in the Gainesville and Manassas area. They've saved a couple $1,000,000. But you know what, Heather? All of this couple $1,000,000 is a ticking tax time bomb. It's all in their TSPs, 401ks and IRAs.
Okay.
And so they've got a couple $1,000,000 saved, but if taxes go up and with fewer deductions in retirement, they could be paying more tax. So what is the solution, Heather? You just asked, is there a solution? Absolutely. We can either continue to hope that taxes stay where they are or go down, which I think very few people think would.
Right.
Or we can take action and plan today. What is a potential solution? To start to do Roth conversions or conversions into Roths, maybe permanent life insurance, but tax-free buckets of cash where we can pay our tax and fair share now so we don't get potentially hammered with higher tax down the road.
Find out more at retirementkeyradio.com.
Financial professionals are not licensed in all 50 states. To find out if Abraham Abish is licensed in your state, please call 571-577-9968. Abish Financial Services is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Abraham Abish, NPM number 770-3575.